Hello, everybody. My name is Michael Duke. Welcome to my show where I, among other things, analyze stocks that are interesting. So, if you find that interesting and you have an interest in markets, investments, finance, and business, then be sure to consider liking this video and subscribing to my channel so you get more content like this. Today, super interesting video. We're going to be talking about Prologis, which is the largest real estate investment trust by market cap. I live in Northern California. Their buildings are everywhere, around every corner I look. I see their buildings. I do have a position in this stock and like it, but today we're going to be analyzing it on its merits today, seeing if it might be an opportunity or not. We'll talk about, as always, overview of the company. We'll talk about the narratives driving the stock. We'll talk about the financials. We'll analyze the risk factors with an investment in the company. We'll do some technical analysis. And as always, we will rate it buy, sell, or hold. Now, these are my personal opinions and are not a recommendation to buy or sell a security. I'm not a financial advisor, folks. Just a guy in a room with all of the fancy tools to do my analysis. So let's get started. So Prologis, what is Prologis? Okay, it's a real estate investment trust, specifically an industrial real estate investment trust. From their own bio here, they call themselves the global leader in logistics real estate, the focus on high barrier, high growth markets. At the end of 2024, company owned or had investments in on a wholly owned or through co-investment ventures, properties and development projects expected to total approximately 1.3 billion square feet in 20 countries. Prologis leases modern logistics facilities to a diverse base of approximately 6,500 customers, principally across two major categories: business to business and retail online fulfillment. Headquartered in San Francisco. I have a background in real estate for those who have been following me for a while. Before I was independent, I worked at a small private equity real estate investment firm, and we focused primarily on industrial. And industrial real estate is the real estate that I'm perhaps the most familiar with, although my private real estate investments are all in single family. But I don't have a ton of exposure in my public equities investment portfolio to real estate investment trusts because I prefer to do private real estate deals. However, I do have shares of Prologis and I have shares of Vici. I've not done a video on Vici, but I might in the future. But Prologis is a very high quality REIT. And part of the reason for that is their low cost of capital. The lower a dividend yield is, all things being equal, the lower the dividend yield for a REIT is, the better it is to fuel their growth. We'll explain that in a second. I've done a video on innovative industrial properties. I forgot I have a position in that as well. I made a very bullish video about that. I was wrong about that stock. That REIT ended up performing very poorly. The one thing that needed to not happen did happen, and that was for their top tenant to default. In fact, I should probably make a video about that coming up. But the REIT space is a lot different than your typical stock investment, and we'll discuss that a little bit. But first, let's do a little bit more background on the company. So, not only do they own and operate properties, but they develop properties. Here's a facility right here that looked like New York City, maybe. So let's take a look here. Their suite of available properties. You see here, this is a build to suit, this here being an available lease. What's interesting here, let's just, again, we're just cycling through what's on the top. Okay. This is in France, this San Francisco. San Francisco is obviously very strong market for industrial real estate because they're not building any of that crap anymore. Okay. Very, very expensive, very, very high barrier to entry. San Francisco is a good market. This Chambersburg, Pennsylvania, I believe that is in Lehigh Valley, also a very good market. Harrisburg, Pennsylvania, I believe that's also in the Lehigh Valley, very good. Cypress, Texas, I want to say that's Houston area. Victorville, that's Southern California, very good. Harrisburg, New Jersey, Northampton, lots of Pennsylvania. This is in Indiana, Spain, Cicero, Illinois. That is Chicagoland, I'm pretty sure. Dallas, Texas, Pennsylvania again, Indiana. That might be Plainfield, Indiana. That might also be Chicagoland. Zevenbergen, Netherlands. Goodyear, Arizona. So you see here, obviously, the visual of the map. They have property everywhere relevant. Now, what's of note here? Exposure to Southeast Asia. That's very interesting. Lots of European exposure. Here, we have a property in Mexico. They've got an error on their website, it appears. Maybe they need some website help. Okay, those appear to be one-off errors there. Maybe we'll need to cut that in post. But when it comes to real estate, it's the cliche is location, location, location. Now, when it comes to industrial real estate, it's particularly logistics real estate, you want to be along the value chain. The value chain in our nation, the flow of goods, well, of course, and this is hot button issue in the news today, the flow of goods is coming, a lot of imports are coming from Asia. And where do those end up? The overwhelming majority of imports coming into the United States, in fact, all of the port volume period is coming in through the port of LA and Long Beach and the port of Oakland. In fact, let's look this up. U.S. ports ranked by volume. List of ports by tonnage. This seems different than data I've looked at before. Conceivably, that Wikipedia page pulled directly from here. Okay. I think this is the unit that I'm referencing here. US ports ranked by TEUs. I think that's old data. Okay. Well, maybe I would urge my viewers to take a look at this data, but the idea here is that we have a lot of volume coming in terms of TEUs coming through Port of LA, Port of Long Beach, Port of Oakland, also in the top 10. Now, notably, what we're looking at here, we see that those numbers are down. Now, what the, this is as of 2022, so it's not up to date data. And I know based on being at that real estate company during this time, that what was going on in the depths of COVID was that you had huge blockages or huge bottlenecks at the West Coast ports. So freight was getting diverted to the East Coast. And you see that Port of New York, Port of Savannah, Port of Charleston, Port of Miami, Port of Virginia, all the East Coast, Charleston, all of those ports seeing large increases. So that was somewhat of a tangent. The idea that I'm trying to demonstrate is that when it comes to freight entering from Asia into the United States, these are your hubs right here, particularly in LA, particularly here. And then that gets on a truck, right? It gets separated out, put on a truck, whatever, and shipped all across, either by rail or by truck. So, of course, you have the east-west movement. That's what makes Dallas-Fort Worth a major hub as well, because you have imports and export activity through the Port of Houston coming up here. Dallas-Fort Worth is very, very centrally located. And then, of course, you have a bunch of freight coming up by truck and rail up through Laredo, South Texas, El Paso, and the other one is Laredo. Did I mention that? Anyways, the idea with logistics real estate is there's hubs being a rail center. I think the biggest rail center is Chicago. You see they have properties there. You have um, truck volume. I think Southern Northern California are major hubs there, and Dallas Fort Worth. And then, of course, you have port marine hubs as well. So when you talk about the transfer of what is logistics, the transfer of goods, containerized freight, so on and so forth, you need a real estate footprint for that product to consolidate, to be broken down, put back together, put on trucks, put on trains, put on ships, and go from point A to point B. Right. So what is Prologis doing? You take a look at some of this, what they have. They have like these big, this here, this is an interesting building, right? Look at this. It's very, very specialized, um, you know, last mile, what they'll call last mile location. In other words, um, product is coming to the you, and you see that reflected by the fact there's a FedEx. FedEx is a last mile type of deal. The businesses located here might be more of like a small e-commerce outfit. So last mile could also be these big bomber units. You see here these big buildings. You take a look at Tracy, California. I drive by this all the time when I'm driving up to Sacramento or down to Fresno. I drive by this building all the time. You see how uniform these buildings are. Now here's if there's LA. With these types of buildings, they're not very expensive to develop. A lot of the times they're tilted up. Concrete walls are tilted up and a roof is put on. It doesn't take a genius to see that it's probably the most affordable real estate that you can build, just because of what entails. But anyways, you see some of these locations that they have. You do have, and there's a Port of Seattle, Port of Oakland, or excuse me, Portland as well. And then all of the East Coast locations here. So yeah, we don't have a bunch of flyover country here. I'm from Boise, Idaho. No presence there. Even in just the U.S., you've got lots of very critical places. I think in the materials we were just looking at in terms of port volume, Port of Shanghai was the largest port in the world by volume, or maybe it was Beijing. You see how they have buildings in Asia, even a building in this website is leaves a lot to be desired on that. I'm trying to give you credit, but yeah. So they location, right? In theory, you have the ability to take a look at fairly granular levels of their portfolio. What I want to look at here is investor relations here. Couple of most recent pieces of news. They recently increased their dividend by 5%. That's somewhat of a deceleration of the last few years. And you can see this by the stock price, the industry, that the niche that they're in really boomed during the first leg of COVID 2020 to 2022. And they've just traded range bound in the new interest rate regime that we're in. All REITs are in a bear market, including Prologis, and have been since 2022. But you see here, it's basically traded flat. I believe that they have a new CEO. Yes, the CEO Hamid Moghadam plans retirement, and the president to become CEO next January and joins the board of directors. So, within the last month, they've announced a CEO transition and a dividend increase. Let's take a look at some more granular data here. Okay, so the largest market that they have is the United States, 797 million square feet, 8,000 acres, 3,800 buildings. The next biggest is Europe, 248 million square feet, followed by South America or other Americas, followed by Asia. They're 95th in the S&P 500, investment grade credit, 200 billion in assets. Number 2 in solar. That's interesting. On-site solar installations. The interesting thing about this company, again, they say logistics real estate. They have those properties. However, there is a big growth driver, and that is right here, data center, office, other. You see here on a net rentable area basis, I believe that's what that stands for. I'm used to GLA, but NRA I think is the same thing. You have the top kind of typical e-commerce stuff, this data center driven by AI, CapEx, big investment theme right now. And I do think that Prologis could benefit from this with smart management. You see here, it's a building in Japan with a robust solar installation. So here's what's cool. They claim 2.7 trillion of goods flowing through their centers each year, representing 3% of the world's GDP, 4% of GDP for the 19 countries where we do business, or 36% of US goods consumption, 1.1 million employees under these buildings working every day, or maybe 2 times a week if they're office workers or something. Anyways, top 10 customers: one, Amazon, Home Depot, FedEx, DHL, UPS, Maersk, big players in logistics. So you see here, a company like Amazon, some of these big Amazon buildings, Amazon might not even own that real estate. Prologis does, or FedEx, Home Depot, companies with big DC. You've got Prologis is the landlord. Very interesting, right? And we see here that funds from operation per share compound annual growth rate, 13% on a 3-year, 12% on a 5-year. Meanwhile, the stock has barely gone up in that time frame, only 13% total. So that's right. The multiple of this has compressed in the last 5 years, making it appear to potentially be a value. We'll get into the valuation here in a moment. But they have very, very, very good looking numbers. So let's take a look at their couple of things in their earnings report. So this was reported on January 21st for the quarter ending December 31st. So net earnings per diluted share, we don't care about that. What we care about is FFO. FFO is $1.50 a share, increased 19% compared to the corresponding fourth quarter in 2023. Core FFO, which excludes net promote is like the upside that they have from selling things. So core FFO is what is basically cash flow, is what that means. Increased 10%, very strong. On a fiscal basis, core FFO decreased from the prior year, but core FFO, excluding promote, 8.4%. Very solid for a real estate company. Real estate is in, again, public real estate is in a bear market. It has been since interest rates shot up by 500%. Obviously, it makes sense. I'm not gonna go into these numbers because we'll take a look at seeking alpha for continuity on that, like we always do. What I do want to do is look at this. Okay, so this is March 2025, very recent. So this is them spelling out their own investment case. Why logistics real estate? Essential infrastructure for commerce, particularly e-commerce, and more importantly for AI. Structural demand, inflation plus market rental growth, CPI index rental growth, long-term outperformance. All these things are true. Industrial real estate has been the best performing commercial real estate of the last 10, 20 years. You see that reflected in the stock price of Prologis in Equinix. Essential infrastructure for commerce. This kind of spells out you have production, raw material suppliers use industrial, international manufacturing order consolidation, industrial on a ship. So either way, this is either international or domestic, ends up consolidating in a DC owned by Prologis, which then gets put on a truck, shipped to a regional DC, Prologis, direct to the retail center, direct to the customer. Or it goes to a e-com fulfillment center, which then gets shipped to the customer. And they even have real estate processing these returns as well. So you see here, if you have essentially a goods oriented business, you selling goods, whether through a brick and mortar retail or a e-commerce center, which you see they have here trademarked as a last touch facility, that you need a real estate footprint for that. Even e-commerce needs a real estate footprint. In other words, brick and mortar brick and mortar commerce, retail commerce needs industrial and retail real estate, but e-commerce really only needs industrial real estate. So industrial has long-term structural tailwinds, which they're talking about here. E-commerce, this is the quarterly volume of sales, $1 billion here. They're saying not only is there more demand, but there's more of a supply restriction. New development average distance from city center in New York City, Chicago, SoCal. Very simple to understand, right? Just like nobody wants the NIMBYs don't want a big, 20-story apartment building in their backyard. They definitely don't want a dirty, smelly, loud warehouse, right? That's why you see these big bomber buildings, like I said, in Tracy, California, on all this, there's land as far as the eye can see, and you got these big, huge 4, 5, 600,000 square foot buildings with, dozens of docks in front. Here's what's interesting. 39% of our customers service basic daily needs, acyclical cash flows. 31% of our customers benefit from cyclical spending patterns. 30% of our customers grow because of structural trends, like e-commerce. Very interesting, right? Real estate is it is considered a cyclical industry, and there's development booms and busts. There's interest rate cycles. Real estate investment trusts are volatile. I think we get the point. This is an interesting thing to think about, where, in other words, when it comes to the movement of these goods, a very small cost savings in transport and labor. AI and robotics are driving more cost savings in the future, by the way. That creates a huge difference in the value or the ability for a REIT like Prologis to push rents. Okay. If that doesn't make sense, just think about a huge company like Amazon. I don't know this for sure, but that idea illustrated is a huge company that's moving tons of goods like Amazon. They're spending a lot more money on people and trucks and gas and transportation than they are on rent. So if they save 1% on moving stuff, they can, in theory, have a lot more room to pay a bigger rent. Here's something interesting. Prologis market NOI rating, in other words, how much of their FFO, their NOI, is coming from a particular market. You see SoCal, at least in terms of US portfolio, lots of rent being driven by here. Now, SoCal's in the news right now because of the LA fire. There's a lot of things going on that are somewhat bearish for residential real estate in SoCal, I think, whether that be just the laws around rebuilding. Now there's a supply shock, which will drive prices and rents up temporarily. But anyways, household formation drives residential real estate prices in a lot of ways, among other things. Household formation also drives industrial demand. However, what we talked about earlier, which is the flow of goods coming in, a piece of industrial real estate is serving a much larger area and is exposed to much more macro economic activity than a house is. The value of a house is dependent on jobs and income and everything within a certain radius from that house, right? Whereas you could have buildings in LA area that are benefiting from economic factors taking place in Denver or Chicago or Dallas because there's goods that are moving from SoCal off a boat to Dallas, Chicago, and Denver, right? So that's kind of the idea. So I look at this very positive, right? To see a lot of exposure to the West Coast port markets, I find that as a very, very positive thing. And I see a lot of bullishness in that. And here we're talking about liquidity, debt, blah, blah, blah. 9 years at weighted average maturity. That's pretty good. These are all good looking numbers. 7.4 billion of liquidity. Debt as a percentage of gross market cap. I think their gross market cap is 1 or 200 billion, 100 billion. So 26 billion of debt. So now we're talking about percentage of area in their portfolio and the different sectors. Now, data centers, okay? Management has talked a lot about data centers, future proofing, gross development. The opportunity with data centers is in development. Here they're saying, yeah, we're in the recovery phase of the market because you see here there was a glut of supply which drove down demand. That's real. Partly why the stock hasn't gone anywhere in a few years, along with interest rates. Digital infrastructure opportunity set. Demand for megawatts. Of course, megawatt is our level of volume or amount when we're talking about a data center. The only thing is it's gone parabolic. What's happening here is AI capex. What management is telling us is that developing a data center has better economics than just some logistics warehouse, right? They're saying not only does it take more capital, but the yields are higher and we create more value for investors. They have 900 million or 360 megawatts under development. Just think about how much that represents. That's 40% of the market. We've 10x demand from 2012. I might be interpreting these numbers wrong, but I think I'm interpreting them right. Basically, what they're saying is, hey, here is total demand. I don't know how they're measuring this. We can find that out by going here, Green Street demand growth forecast for top markets. That might be worth investigating. But let's just take it at face value for now. What they're saying is, hey, we're developing 360 megawatts right now. This is March 2025. That's not even $1 billion. They're saying that the long-term opportunity, 10 gigawatts. 10 gigawatts. Okay. Typical investment, 150 to 500 million. 3 data centers. Okay. 360 megawatts. Times that by 10. That's this amount, right? That'd be 9 billion. Times that by 2, or is it times 100 or times 1,000? I'm not going to go through the mental gymnastics of figuring that out. Basically, what they're saying is, hey, everybody, we just walked you through all of the tailwinds that we're experiencing. These are all the tailwinds. These have been happening for a while. E-commerce has been driving industrial real estate. What do you think of? You think of all like manufacturing and factories and stuff. No, just buying goods has been driving industrial real estate. You got to understand that, right? But now what they're saying, hey, we're already exposed. We are the best investment product out there, guys, for you to take advantage of these long-term tailwinds in industrial real estate, which I somewhat might agree with. But then you have this data center thing that's happening because of AI, and they're saying, yeah, like that's actually even better. You think about some of the things that are going on right now. They're already developing $1 billion worth of these projects with more to come. That's the overview of our company. Do they have a moat? Yes and no. Yes and no. Yes, they have a moat in the location of the properties they have, in so much as they own it. Location, location, location. If I own the best property on the best block, I have a moat over somebody that doesn't. But is developing a piece of real estate, particularly a warehouse, what is moaty about a company like Prologis is the fact that they have a low cost of capital. I don't know if they talk about that here. 3.2% weighted average interest rate, weighted average remaining maturity of 9 years. Their dividend yield being 3.5%. If they issue shares today, if they 100% equity finance which they wouldn't, but they might. Their cost of capital is really low, guys. If I want to go buy a piece of real estate, my debt is floating above SOFR or the it's floating, okay, at 8 or 9%. When I left my job at the real estate company, I was working on procuring debt for our acquisitions. We were interest rates got so high, up to 7-8%, that we were having to hedge our exposure with interest rate swaps. So if a small private investment shop is going to have to go get debt at 8-9%, this company right now with the treasury being on a 4 handle, it's going to raise debt at maybe 5%, maybe. Spreads are really low right now. Okay. And then if they 30% equity and 70% debt finance it, their equity is only 3.5%. So you get the idea. The moat of a REIT is of their existing portfolio is location based. That drives rent growth. Of course, we've got tailwinds, but barrier to entry is, hey, I own the best property on the best block and I'm not going to sell it. That drives growth. And then you also have the cost of capital moat that they enjoy by just being a premium investment product. So does it have a moat? Not exactly, but it has strong competitive advantages over other real estate operators. Let's take a look at the financials. Here's our income statement. From 1.5 billion to 7.5 billion in the trailing 12. That's a 6x, 5x. So 5 times growth. Oh, sorry, that's just rental revenue. Sorry. 2.35 billion to 8.5 billion. 3.5 times. Very, very strong rental growth. Revenue growth. Operating income, 564 million to 3.5 billion. That is like a 6 to 7 times growth. Okay, really strong. Okay, really strong. Now, when it comes to a REIT, we do care about what they're paying in interest. They're making money by selling assets too. Earnings from continuing operations, 925 to 4 billion. 925 million to 4 billion. 4x earnings. It looks like we're missing some data here, which is annoying, but what we're seeing here is 1.3 billion of funds from operation of 5.8. Very good looking financials. The dividend per share 1.5 to almost 4. Okay. So Their payout ratio, something, I'm doing mental math wrong, but the idea is that looks phenomenal. Balance sheet is very important for a REIT. So let's take a look at that. Total real estate assets. We don't want to look at total because that nets out depreciation. We want to look at gross property. My new keyboard doesn't have the calculator thing attached to it. We're just going to take a look at 92,166. I'm going to put this on my screen here. 92,166 divided by 27,615. So our gross property, our approximate real estate assets, up by 3.33 times. Meanwhile, our rental revenue, remember that normally I do mental math, guys, so bear with me here, divided by 1,536. Okay, so our rental revenue up by 4.9 times versus assets increasing. In other words, rents are going up, okay, and they're snowballing. All right, looks really good. Now, our assets, our real estate assets, again, 3.33 times increase. How's our debt look? 11.6 billion to 30.3 billion, not quite 3 times. So, lockstep, but they're not just bloating themselves with debt at a pace greater than, otherwise. So how much cash do they have? Where's their cash? Cash and equivalents, 264 million, 1.3. Now, I think when you look at a REIT balance sheet, it's very, very easy to be like, whoa, they have so much debt compared to how much cash they have. But there's so much value tied up in this line item here. So yeah, REITs typically do not have a lot of cash compared to their debt and their real estate assets. That's okay. That is okay. We see here that their share count has not doubled in that time frame. Again, what you want to see, FFO per share and book value per share go up, which they have handedly. Balance sheet looks great, guys. What about the dividend? Let's take a look at the dividend yield over time. A little above 10-year averages. The yield got very low, like 1.5% at one point. That's a low yield for a REIT. It really is. It's a high yield for a stock, low yield for a REIT, but good, very, very strong. As a reminder, REITs are required to pay out, I believe it's 70% of all of the cash flow from their real estate activities or something like that. Maybe it's 90% of their real estate activities. So all REITs are required to pay a dividend. The yield of that is, both just indicative of the confidence. Very low, indicative of quality. So that's a valuation metric. We have low yields. The company grades poorly on valuation metrics, in many valuation metrics. Here are price per FFO being 20 times, right? 20.11 times on a forward-looking basis. 1 divided by 20.11. So our implied cap rate is 4.9. I don't know what cap rates are on industrial right now, but I would imagine that they're higher than that on average. Okay. So this multiple, and it's even worse on an adjusted funds from operation basis. I think their valuation it's not great despite the demonstrable underperformance. What can I look at? FFO, cash flow, maybe. These are apples to apples numbers. Our valuation is pretty in line with historical averages. You had this period from 2018 to 2022 where it really went bazonkers. It's come back down to earth. So the valuation is it's not great. Effectively a 5 cap implied, and you're getting a 3.5% coupon. However, as far as real estate quality goes, again, we're not looking at the individual schedule of their properties. Very high quality. And in all things being equal, market, the higher the quality asset it is, the lower the cap rate it is, just like a bond or a stock, right? So, do I think that it's some value deal right now? Not necessarily. Don't let this chart fool you. You see the stock price come, it's like so high here and it's down from there. Don't let that fool you into thinking that this is some like screaming deal. Okay. But I do think that the price is fair. I really like the long term outlook of the stock. So, yeah, financials look excellent. The fact that they raised the dividend 5% is kind of indicative of, if I reference back to the presentation here where they're talking about, yeah, we're coming out of kind of the down cycle here. In these periods, they they were making a bunch of money on development and they were pushing rents a lot. So they were able to raise the dividend by 9 cents. I mean, that's like 20 something percent growth you see here. So this REIT is kind of in more like normal plotting consistent times is raising the dividend by 5-6% per year. You combine that with a 3.5% yield right now. That's like pretty consistent and sound, like 8 to 10% appreciation potential, total return potential. I think it's not the best I've seen by any means, but it's really strong potential. So we see here the dividend was raised a lot from here to here, and the stock has really not gone anywhere. The fact that they raised the dividend by 5% basically says like, yeah, our future is good, but the boom times that we saw in these years, yeah, those aren't happening right now, and I think that that's fine, right? So this is the long term chart. Again, you see, it just kind of it really went parabolic, and now we're trading in this range bound. So, if, in terms of our technical analysis, let's just be real simple with it. It's just consolidating, right? So, honestly, I feel pretty comfortable as a buyer, somebody who, if I'm a believer in this stock and I think it's time to execute a trade, I feel comfortable really anywhere within this range. If I am a long term holder, I think it'll be higher in the future. Let's get an arrow. It's harder to get an arrow than we thought. But I think when it comes to this support line here, and there's a lot of volume, each of these candles is a month. Each of these candles a week now. Do you notice something? You see these big red candles here where it just nukes down on high volume. Well, a that happened here, somewhat happened here. It bouncing off this $100-ish mark, very reliable indicator. And in most cases, the stock has recovered by 30% from that time. So if I'm holding it for the long term, I see no heartburn over entering into a trade here. However, if I'm trying to, make a quick buck, then you see this chart. I mean, it's been very reliable to purchase it right around the $100 mark and hold it up. So, what do I think it is? Do I think it's a buy? I do think it's a buy. It's not like a screaming buy. It's not. I think that this, at the valuation it's at now, it's a reasonable price. It's a fair price. It's not a great price. The long term outlook is very good. There's tailwinds there. It's had some challenges the last few years, but it's got a lot of growth trends attached to it, and I really like that. So I find it really unlikely that it would sell off below this territory. I mean, you even see here it consolidated right around that range, and that was a level of resistance here that it sold all the way down. I mean, it went down by 50% in March 2020. Have a really hard time believing that it would trade below $100, and if it did, the next stop would be 90. So I really don't see much downside here at the current price. But if you're really looking for a value, maybe just wait to see if it trades all the way down. But what if it doesn't, right? One thing I am seeing here that isn't great is this. It reliably traded except for here. I mean, that's kind of more akin to what happened here. It kind of consolidated in the 120s, right? Before it broke down further, came up. So the stock's just been in no man's land. Obviously, if interest rates come down a lot, I think that does maybe in an environment where interest rates are coming down, stocks are probably coming down too. So it's probably selling off, but that would be good for a REIT for lower interest rates. It already has a lower cost of capital, so it's advantaged in this higher cost of capital environment. The underlying business performance, I think, and outlook is very, very strong. So yeah, I graded a buy. I do. But technically, this isn't a super attractive entry point, but it's not bad either. And I do believe that it will do well from here. But you have to be very patient with this one. Um, the near term catalysts, I just don't see them. You got to be really patient with this if you're looking to enter. So hopefully you've found this video instructive. Please comment below. Please be sure to like and subscribe to the channel, and reach out to me. Talk to me. Let's talk. Hopefully you found this entertaining and useful. I do talk a lot, but I do enjoy making these videos, and hopefully you enjoy watching them. So I've got to wrap this up before I run out of time, but I hope to see you next time. All right. Thank you for watching. Bye. We didn't talk about the risk factors. Interest rate risk, I think, is the primary thing. If rates stay higher for longer, the performance of the stock price might be sideways for longer. I mean, that's really the main risk. Sideways for longer is the main risk factor here. But underlying business performance, I don't really see e-commerce slowing down. You have cyclical risks with consumer spending on that, and the AI capex thesis might not play out quite to the degree that they think. That's a risk, but I don't think any of that is really baked into the current price. I mean, yeah, it's expensive, but at the current price, I don't see a ton of downside, and I see plenty of upside. It'll take 10 years minimum to get there. So anyways, I went on too many tangents in this video to discuss the risk factors in depth, but hopefully you found that instructive. All right, I got to keep it less than an hour on my raw recording, so I'm going to sign off now. All right, thank you for watching, and I will see you tomorrow.